Just how important have earnings been to investors? A new report from the Wall Street Journal says that given the long rally we've seen, financial reports failed to push as much punch as they used to. Joining us now, Cantor Fitzgerald, Chief Market Strategist. Peter Cecchini. Good to see you, Peter. Thank you so much for joining us.
Thank you.
Peter Cecchini.
Yes.
Is how I wanted to say it. Good to see you.
Said.
Let me ask you about trade and how important that is for this market. What do you think are the big risks for this market now that we see another rally underway right now?
Well, I think obviously tax reform was a big story early in the year. Trade is the most recent story. Most would agree that a trade war would be bad for growth globally and would pose a non-trivial risk to global growth, in my view. I think there's going to be pushback in that the positioning of the White House is going to be softened, and as a result, it's going to be less of a worry, I think, than markets felt it might be a day or two ago, especially with the pushback coming from Congressman Ryan.
Have you guys worked out numbers on it at all in terms of, for example, Paul Ryan, the Speaker of the House, who you referenced, kind of talked about how this could wipe away some of the benefits of tax reform. Dagan mentioned a study that was out, I guess the other day, that said net job losses could equal like 146,000 as a result of the tariffs if they're fully implemented. Have you guys started to play around with numbers here?
I think it's difficult to quantify.
Yeah,
I really do. You can do regression analysis looking at analogous historical periods and things like that, but it's really hard to quantify. I think net though history shows that trade wars are bad, generally speaking.
You're more focused on rates.
I really am. I think rates volatility, especially the rise in two-year yields and the increase in LIBOR, which has real impact on companies. Right? Bank financing is based on LIBOR, and three-month LIBOR is now at 3%, or at 2%. The 2 years now at about 2.22, and this to me has been the real reason why equities took a breather early in the year, and the reason we've seen more volatility in equity markets as well.
What about the headline risk of this, though? It seems to be a lot of the conversations I had yesterday were, why now? Why threaten these or announce these tariffs now? Is it because you have the tax reform, because companies are on good footing, because the world is on solid economic ground? But what about the headline risk of where you have a market that's been shaky because of higher interest rates, because of concerns about an overreaction to inflation by the Federal Reserve and central banks, because of the pullback in these portfolios at the Federal Reserve? Does this headline risk, can it go away, or does it just stir up more volatility and make a situation worse?
I think it makes the situation worse. I think it exacerbates it. But at the end of the day, I don't think it's the driver, because I don't think it's going to evolve in a way where there's some sort of a Pyrrhic victory where, we win but we lose.
Yeah, but if it's impacting earnings, I mean, we're talking about the impact on GM and Ford. Obviously, the auto sector comes to mind. We were looking for 18 to 20% earnings growth for the S&P 500. Yeah. If that changes, doesn't that change the dynamic of the stock market and whether or not to buy it? Do you still expect earnings growth of 20% this year?
No, I actually do not. I think that the stock market is priced to perfection right now at about 22 times trailing earnings, versus, let's call it 17 or 18 on average. And I think economic growth globally is strong, but I don't think there's a lot of room for error. And again, that's why something marginal like the discussion around tariffs matters so much, because things are priced so precisely to the perfect scenario.
So would you sell into this rally?
I'm certainly not a buyer. I'm somewhat neutral here. My target for stocks for this year was about 28.65. We hit it actually.
28.65 on the S&P 500. We're
yes.
at 27.30 right now.
Yeah, 28.65 on the S&P 500. So we're not that far away. So I'm a better seller than buyer, I suppose, but somewhat neutral at this point.
All right, we will leave it there. Peter, good to see you.
Thank you.
Peter Cecchini joining us there.